Good afternoon. My name is Charlie, and I will be your operator today. Welcome to CN's third quarter 2021 financial and operating results conference call. All participants are now in the listen-only mode. After the speaker's remarks, there will be a question-and-answer session. I would now like to turn the call over to Paul Butcher, Vice President, Investor Relations. Ladies and gentlemen, Mr. Butcher.
Well, thank you, Charlie, and good afternoon, everyone, and thank you for joining us for CN's third quarter 2021 financial and operating results conference call. Before we begin, I'd like to draw your attention to the forward-looking statements and additional legal information available at the beginning of the presentation. As a reminder, today's conference call contains certain projections and other forward-looking statements within the meaning of the U.S. and Canadian securities law. These statements are subject to risk and uncertainties that may cause actual results to differ materially from those expressed or implied in these statements and are more fully described in our cautionary statement regarding forward-looking statements in our presentation. After the prepared remarks, we will conduct a Q&A session. I do want to remind you to please limit yourself to one question. The IR team will be available after the call for any follow-up questions. Joining us on the call today are JJ Ruest, our President and Chief Executive Officer, Ghislain Houle, our Executive Vice President and Chief Financial Officer, Rob Reilly, our Executive Vice President and Chief Operating Officer, James Cairns, our Senior Vice President, Rail-Centric Supply Chain, Helen Quirk, our Senior Vice President and Chief Strategy Officer, and finally, Keith Reardon, our Senior Vice President, Consumer Product Supply Chain. It is now my pleasure to turn the call over to JJ Ruest.
Thank you, Paul, and good evening, everyone. Today, we will do our prepared statement in two parts. Ghislain and I will cover the highlight of the third quarter. We'll keep that section tight, and then the team will cover the progress on our September 17 action plan. Well, let's first start with the highlight of Q3, and I'm on page 5. All in, on an adjusted basis, the base business produced an adjusted diluted EPS growth of 10%, an adjusted operating ratio of 59.0%, and free cash flow for the first 9 months of just over $2 billion. The operating ratio started higher in July, resulting from the 2-week loss of our CN main line to the Port of Vancouver, but improved afterward in August and September to an adjusted 59.0 OR as the average for the quarter. Regarding pricing trend, James Cairns will provide evidence of solid pricing at CN in the last couple of quarters. Regarding headcount, of the 1,050 that we mentioned in our September 17 conference call, about 70-75% are completed. At CN, we have a long-term strategy, and we railroad for all key stakeholders. We make sure the railroad has enough infrastructure to support the economy. We railroad to reduce carbon emission. We railroad to support our customers so they succeed and grow in their market. We railroad to produce good return for our shareholders, and we railroad to create an engaging and safe workplace for our employees. I will now turn it over to Ghislain, who will walk us through the quarter.
Well, thank you, JJ. My comments will start on page 7 of the presentation, which will provide more visibility on our solid third quarter performance. Revenues for the quarter were up 5% to $3.6 billion, despite volumes on an RTM basis being down 1%, which were impacted by forest fires in July and supply chain constraints throughout the quarter. We delivered pricing well above rail inflation and continue to focus on yield management, optimizing CN's precious network. Adjusted net income was $1.080 billion, with adjusted diluted EPS of $1.52, both up 10% versus last year. Other income was down by around $30 million versus last year due to a mark-to-market loss on an equity investment in autonomous driving technology. Our adjusted results exclude various non-recurring items related to the KCS transaction costs, including the $700 million U.S. break fee from KCS. Our adjusted results also exclude a workforce reduction provision as well as advisory costs related to shareholder matters. Turning to page 8, let me highlight a few of our key expense categories expressed on a constant currency basis. Labor and fringe benefit expense was up 12% versus last year. This was mostly driven by increased wages due to a 5% higher average headcount and a workforce reduction provision, partly offset by higher capital credits from more capital work in the quarter. Excluding the workforce reduction provision, labor and fringe benefits was up only 6%. On a sequential basis, the end-of-quarter headcount was down 3% compared to the end of Q2. Fuel expense was up 40%, driven by a nearly 50% increase in price, partly offset by continued improvement in fuel efficiency. This quarter saw a significant improvement in equipment rents with a 31% decrease versus last year, driven by lower car hire expense, mostly due to improved online productivity and lower volumes. Now moving to cash on page 9, we generated free cash flow of over $2 billion through the end of September, around $50 million lower than 2020, mainly from lower net cash from operating activities due to higher cash taxes. We have resumed our share buybacks and plan to complete our $1.5 billion program by the end of January 2022. Moving on to page 10, we are reaffirming our full-year financial outlook and expect to deliver about 10% adjusted diluted EPS growth versus 2020. While we are now assuming volume growth in terms of RTMs to be in the low single-digit range for the year, we are executing on our strategic plan that has started delivering benefits in Q4. We still expect to deliver free cash flow in the range of $3 to $3.3 billion, which will drive further improvement in free cash flow conversion. I will now turn the call back to you, JJ.
Well, thank you, Ghislain. And before I get into the progress of our September 17 action plan, as you already read from the press release, I am retiring effective as of the end of January 2022 or such later time as a successor has been appointed to ensure flawless transition. I am not going anywhere, and I will deliver with the team here today around me on the fourth quarter result and to be sure that we have a successful setup to the 2022 business plan. The board has also, as you read in the press release, has appointed a search committee for a world-class CEO. The detail on the board committee that will do so is also in the press release. Back to the business. On September 17, we announced the next step in our strategy to redefine railroading for the next generation. CN will execute on our plan, deliver high-quality service to customers, and generate enhanced and sustainable return for all shareholders. Our long-term goal remains to consistently deliver double-digit EPS growth. I would like to begin by recapping our 2022 objective. We are targeting $700 million of additional operating income for next year. We intend to use a balanced approach, including optimizing railroad productivities and labor costs. We also expect to adjust our capital spend to 17% of revenue. We can do this without compromising our absolute commitment to safety and customer service because of the current good condition of our network and by putting to good use the technology investment we made in recent years. Another major component of our plan is lowering our operating ratio, starting with 57% in 2022. Achieving 57% next year will unlock significant near-term value while maintaining and balancing our commitment to customer service and safety. We will achieve it with operational excellence, rationalizing our cost structure, price, and finally, volume when grain returns late next year. We are assessing opportunities to go lower beyond 2022, but responsibly, and there will be say more to that in the new year. We are targeting EPS growth in the range of 20%, return on investment capital range of 15%, and about $4 billion of free cash flow for 2022. I am pleased with the quick progress thus far and the initial positive feedback received from shareholders and stakeholders both. I will now turn it back to the team, who will provide an update on how we started to implement the key initiative that will deliver results in Q4 and in 2022. Ghislain?
Okay, on page 13, we have already made considerable progress on our total operating income improvement of $700 million for 2022. For the $250 million in labor, we have already completed around 75% of the reductions identified on our September 17th call. We will be substantially complete by the end of the year, which will provide a full year impact of these reductions in 2022. For the $300 million in purchase services and material and other items, we have already secured around $100 million of initiatives in the past month, of which a few examples include the reduction of contractors through the entire company, both in the field and at headquarters, a reduction of IT applications, aggressively storing and retiring older locomotives, which will reduce purchase services and material costs associated with their maintenance. Finally, we'll deliver $150 million in additional price initiatives as we continue to enhance our yield management strategy. I will now turn it over to Rob.
All right, thank you, Ghislain. As stated on September 17th, operational excellence, our commitment to safety and service to our customers have been and will continue to be cornerstones in our strategy. All of our core operating and safety metrics have improved over the past couple of years, leading to greater efficiencies and improved customer service. We continue to build on our positive momentum through our strategic initiatives. A big part of our operational excellence is in operating the railroad sustainably. Our fuel efficiency for Q3 was an all-time record. Our position as the industry leader from a fuel efficiency perspective underscores our commitment and enhances our operating performance and profitability. CN's industry leadership and sustainability and success in operational excellence have been achieved through a continuous and concerted effort by the team. We are on track to deliver all-time bests in productivity in our operations, fuel efficiency, and most importantly, the safety of our employees. We are running a safe, efficient, and sustainable operation that consistently meets the needs of our customers. I'll now turn it over to Keith and James to outline CN's growth vision. Keith?
Thanks, Rob. Current worldwide port congestion, especially on the U.S. West Coast, highlights the CN network intermodal advantage. 3 coasts, 13 proven uncongested port gateways, several that are meaningfully expanding their capacity. Single line, single owner access from each coast to the U.S. Midwest links the efficient gateways to where the markets are and where they will be. Our inland terminal network is well established. Terminal and container asset technology-backed investments are creating capacity and efficiency, improving safety, and improving the customer experience. The intermodal story for CN is strong, with decades of opportunities ahead. James, I believe you also have some great long-term carload markets that are developing.
Yeah, thanks, Keith. I've never been more excited about our long-term carload growth potential than I am today. Our unique geographic reach and exclusive access to the Port of Prince Rupert will help us be a leader in carload growth over the next several years. Canadian grain recovery in Q4 2022 will be followed by emerging new renewable fuels and refined petroleum products projects that will propel our growth through 2023. What I am most enthusiastic about are new green energy carloads related to Alberta's massive growth in hydrogen and energy projects, evidenced by the slew of recent announcements around the Alberta industrial heartland. Hydrogen-related carloads have the potential to be of the scale of crude by rail at its peak, but with long-term rateability. Our end-to-end supply chain model that helped us create new export capabilities for propane is easily replicated for blue ammonia and other hydrogen-derived energy carloads. If we move to the next slide. We routinely get asked questions about revenue per RTM. Our view is that this measure is a better proxy for mix than it is for price. That said, since December 2018, when we started our customer-centric journey under JG's leadership, CN has seen the fastest growth in revenue per RTM for all Class 1s to the end of Q2 this year. We believe a better proxy for price is, well, price. As you've heard us say before, we consistently price ahead of railway cost inflation. In the last 5 years, our corporate same-store price has been on average nearly 2% greater than rail cost inflation. We have been preparing for accelerating railway cost inflation by sequentially increasing our price each quarter since Q4 2020. Our various incremental capacity auction programs provide real insight into the market rate for our valuable capacity, allowing us to smartly price to meet the market without undue volume risk. I'll turn it back to JJ.
Thank you. Thank you, James. Thank you, Keith. Thank you, Rob and Ghislain. Looking to 2023 and beyond, The CN team is focused on delivering solid results and see the opportunity to further improve our operating ratio as we continue to prioritize safety, railroading for customers, railroading to reduce carbon emission, a balanced approach, value over the short and long run. Our network is great. Our ambition is to build a premier railway of the 21st century, investing in technology, investing in capacity, delivering service that attract more customers to the rail network, improve safety, reduce carbon emission, create the essential capacity for the economy, and reduce. We are on our way, well on our path to now be well positioned to lead the industry to the next transformation of railroad. To conclude, CN is taking a balanced approach. We are investing in the success of our workforce and communities, and as well as return for our shareholders. We will now turn it back to the question. Charlie?
Thank you. We'll now begin with the question and answer session. To ask a question, you will need to press star one on your telephone and wait for your name to be announced. To withdraw your question, press the pound key. As previously mentioned, we ask you to kindly limit your question to one. The first question comes from the line of Ken Hoexter with Bank of America. Please go ahead.
Good afternoon, Ken.
Hey, good afternoon. JJ, maybe I can start with I know one question, but I guess you're now maybe retirement. Maybe your thoughts on the outlook here. You talk about decelerating growth. Maybe talk about I know Keith and talk about your outlook on the as you step away.
Yeah. So where we're at, I think you can. Where we're at right now, I think when the world driving price. We're in the world, it's positive in some places, not so positive in other places. And so therefore, we have to adapt to that. And I think we're also in a world where it's time for us to be really setting for the future. That's why there's such a focus on DSR, leveraging technology, using we're relevant to our customers, all of them, big and small, and creating value. So I think the rail industry has a huge opportunity is to be more relevant to the supply chain, working with ecosystem at the port, making the best mousetrap to attract more vessels. It also has an opportunity to attract more freight on the highway and converting that to the railroad. It doesn't come in at the same operating ratio. I think it's well understood by all, but it's very much part of the long-term success of the rail industry is competing with other modes and doing so in a way that's relevant to customers whose freight, is they're the one who decide what is spend their money. So I think really the rail industry has a great future. It just needs to remind of the basic. You got to have as many customers as you want to make these rateable. Thank you.
Thanks.
Comes from the line of Walter Martins. Please go ahead.
Thanks very much. Good afternoon, everyone.
Good afternoon.
And when I look at what changes with your strategic plan, there's level of management. It seems to be fairly or closer aligned to what. I guess my question is there room for an engagement here now? Think that's possible? Is that going to be something you're going to be looking for? Or is this more of an independent approach that you plan on taking with regards to the CEO search and proceeding as planned with the March 22nd meeting?
Thank you, Walter. And if I may say, I think it's maybe the other way around. Is maybe TCI is getting closer to what CN's long-term strategy is. I hear more comments about. First of all, when they ran out the press release earlier this week, it was a bit of a vague presentation, but no clear target. And a press release is not a plan in itself. But they were talking about the things like, long-term, emission, where customers came out more balanced. And I think regardless of, but regarding further engagement with PCI, I won't specifically speculate for that. I'll let the board engage with the activists. But the strategy that we have here is very, very clear, right? We want a balance we want a railroad for all stakeholders. We want to be a growth company. We want to be a safe company. We want to be a company who has enough capacity so that when demand surge or peak, and we've seen this in the past, that we don't let the economy stranded, and that we create an environment where our industry is successful, not because it's a duopoly or tree duopoly within North America, but it's successful because more and more customers want to do business with us, and more customers want to use our port by choice, and more customers want to leave the highway and join our respective intermodal network. So I think that's long-term, that's where the future is. And we talk about technology often. It needs to happen. We need to have technology that makes the railroad safer. That's more about the maintenance side. Technology that create capacity without necessarily having to lay down more track. And technology also that makes the service to our customers who all buy supply chain. They don't buy a rail service. They buy a combination of transportation mode, and therefore having technology that makes it easier for them to track and trace and maintain the inventory that they have. So it's maybe a little more sophisticated than how low can you go on the operating ratio.
Appreciate the color. Thanks, JJ.
Thank you. Thank you, Walter.
Your next question comes from the line of Cherilyn Radbourne with TD Securities. Please go ahead.
Hello, Cherilyn.
Thanks very much. Good afternoon. In terms of the pricing environment, could you speak to what the spread versus inflation looks like as we sit today, and how much of the book of business has been repriced in this tight freight environment, and how much is left to go through year-end and into early 2022?
Thank you. James will cover that. He's my pricing expert.
So thanks for the question, Cherilyn. So very interesting. We've been preparing for ramping up of inflation here since Q4 of 2020. So we've been very careful with a lot of our contract renewals not to go out too far because it was an uncertain environment. We've got a pretty big chunk of our business that's going to be available for repricing still Q4 this year and into next year. I don't know the exact number, but somewhere in the range of about 35 to 40% of our entire book of business that we can reprice. So we're pretty excited about that. We'll make sure that we're pricing well ahead of railway cost inflation. And to date, this year, we've been just over 5% on our same-store price. So it is bearing out that we're able to secure these price increases because the customers realize they need the capacity that we have. Increasingly, as we move into 2022, that capacity is going to have more value, and creating that level of certainty for customers with a contract in hand with CN is worth something to our customers. So we'll continue on that path. We'll be pricing ahead of railway cost inflation. I think a good mark is somewhere between 1.5% and 2% ahead of railway cost inflation is where we think we're going to be balanced of this year and into 2022. Thanks for the question, Cherilyn.
Thank you.
Thank you.
Your next question comes from the line of David Vernon with Bernstein. Please go ahead.
Go ahead, David.
Hey, good afternoon, guys. Thanks a lot for taking the time. Hey, Keith, could you maybe talk a little bit more about what kind of tailwind we can expect on international intermodal pricing, given where steamship rates have headed over the last sort of 12 to 18 months, and the timing for when some of your international intermodal contracts may come up?
Go ahead, Keith.
Thanks, David. Price has a lot of different aspects to it. I'll start off with our same-store price, and then I'll talk about some other things that we're doing. But the same-store pricing, you're right, we have had some contracts come up. We will continue to have contracts come up. It happens all the time. In these last two contracts that came up, big ones, we had the opportunity to look at the book of business and actually upscale our business. There's some business that we did not think was compensatory to the workload that we put into it, so we jettisoned some of that business. And we didn't do it in a adversarial manner. We worked with our customers and we said, you know what, we'd rather focus on these areas, and we provide those services to you. So we will continue to do more of that. You know, we started in our upscaling, as James mentioned, but we also are looking at taking our latent capacity that's been created by some of these supply chain issues, and we're selling that at premium rates, working with our customers. So we're taking every opportunity to talk to our customers to figure out what they want to accomplish, and then we're creating value for them, and we're usurping that value for CN as well. Thank you, David.
Thank you, David.
Thanks for the color. JJ, if I could squeak one more in here, is there a timeline for the board's search process?
So the board is looking for the best of the best, and they want to take the time to make sure that we find and determine the best of the best for the next generation of a CEO here at CN. So they're not on the clock. It doesn't mean that they will go slow. They'll work. They'll want to be sure that it's a very important task. But at the same time, we're not going to put out a specific time by which this will be done. As I said in my opening comment, and I think it's also in the press release, I'm staying till the end of January or whenever is required to do the smooth transition. And at this point, we're looking for the quality, and sometimes quality takes a little time. So I would refer you back. Thank you. Refer you back to some of what's said in the press release. It was worded very specifically.
Great. Thank you.
Thank you.
Your next question comes from the line of Konark Gupta with Scotiabank. Please go ahead.
Good afternoon, and thanks for taking my question. So I just wanted to understand, given the global supply chain disruptions we are seeing right now, how the streamlined shipping customers they're thinking about the whole dynamics here. Are they looking to incrementally look to Canadian West Coast ports, especially Prince Rupert, or they are looking more sort of east to kind of decongest away from Long Branch and LA? So any thoughts there, please?
So maybe Konark, I can start, and Keith can add a lot of color. That's his space. But one of the comment made earlier, I'm not sure if it was understood, that as some of the business we decided to not renew some of the lane, that created capacity at Rupert. Capacity at Rupert was sold out. That created capacity at Rupert. So now Keith and his team have been able to do some new vessel. You've heard about these pendulum vessel, smaller vessel that some of the retailers in North America are now going out and charter themselves. So they only pick up freight at a few ports in Asia, and they drop it off at one port in North America, and they want to avoid at all costs LA Long Beach or any places where a vessel are delayed. So for us to be able to do this and do this at a premium price, it has to be with other customers when we were not on a contract, and also do this at the port, Rupert, which now has some latent capacity, because some of the business that we and the customer would not see eye to eye on the yield of it, we've actually let it go. So I don't know if you want to talk about the future, Keith, and how many more months or quarters this may last.
Yeah, and just to point out, the supply chain disruptions and what's happening to these vessel strings are what's causing some of this transitory volume issues that you've seen for Rupert and Vancouver, down for us. So that was the factor that got us taking a page out of our playbook to go back to some of these customers, as JJ pointed out. I will also say that year over year, we've seen the East Coast ports that we service, as well as the Gulf Coast ports that we service. We're up 20% over last year, and that's a diversification approach by the customers. Not only the steamship lines, but the people that are in the boxes. They're saying, "I want another gateway," and that's why the CN network is set up so great for that. We've got 3 coasts, 3 different ways that they can get in, 13 different ports. So that's why we're so happy that we have this network. That's why we're so bullish on the future.
Thank you, Konark.
Thank you.
Your next question comes from the line of Jason Seidl with Cowen. Please go ahead.
Thank you, operator. I wanted to talk a little bit about the headcount reductions. You said you're about 75% through that. Did all those come in 4Q here early on? And what's the mix sort of between the U.S. and Canada with those reductions?
So I think Ghislain will cover that. Just to let you know, we're extremely focused on executing on that, Jason. And we actually track this daily to a great detail. So, Ghislain?
Yeah, Jason, I'll give you a bit of a color on the mix of headcount. As we said, we have about 75% out of the 1050 that we announced on September 17th. I would tell you close to 600 is the management, and close to 200, call it 190, is union. I would say the lion's share of it is in Canada, and that's what I would tell you between Canada and the U.S. But I'm giving you the color here on the management versus union.
Yeah, I know, Jason, that people are typically tracking headcount in the U.S. for Class 1 railroad. Most of what we talked about here is happening in the Canadian side.
Yeah.
So you won't see that in our headcount for our U.S. network because most of our management position on the Canadian side, and most of the reduction that we've done or are doing you'll find them on the Canadian headcount, not the U.S. headcount. That's right. I don't know if that helped.
No, that helps. I'm sorry, I might have missed it. Did you say most of that was done by the 17th?
Most of them, they were done after the 17th, right? On the 17th, we announced the 17th. And then after that, we started to roll out, and 75% of that is done as we speak.
As we speak. This is as of today, give or take. It's about 75% of the 1050 that are done.
Yeah, so that will impact the fourth quarter result, current result.
Gentlemen, I appreciate the time and color as always.
Thank you, Jason.
Your next question comes from the line of Brandon Oglenski with Barclays. Please go ahead.
Hey, good afternoon, everyone. And JJ, just wanted to acknowledge it's quite an extensive career at CN. So best of luck on the other end. But I guess, it would be great to get some perspective from you because obviously you were part of a team, earlier when CN was viewed as really best in class. And I guess, what are you looking for your, the person that takes over for you? What do you think they need to get right here to get back into the driver's seat of being the best railroad, or at least the best viewed railroad in North America?
Well, thank you, Brandon. Yeah, I joined CN back in the month of May of 1996, which was about 6 months after CN was privatized. I think the landmark of CN is to be innovative, to lead the industry, to take risks, and to do things that maybe early years are not understood or accepted by others. Right? This is what scheduled railroading was all about. A lot of naysayers at the time, it was not going to work. The IPO was a big thing that a lot of people at that time, especially Canadian investors, thought it was not going to work. And then where we're at today is we're looking to the future, not the past. CN is not trying to be in 2025 what it was in 2010. CN is looking to be, what the future looked like. So we're looking to be a growth company. I think we want somebody who's focused on growth, somebody who's focusing on bringing technology into the company, somebody who's focusing on, having a workforce that presents today's society. So, bringing talent from where it is, different gender, diversity, inclusion, a workplace that is fit what the young people or the people in middle career are attracted for, et cetera, et cetera. So I think the future is where you want to be. As Gretzky said, you want to go where the puck is going to be next, not where the puck was in 2010 or 2015. So I think that's really, when you look for a CEO in early 2022, you want to have somebody who can actually get the company to where it needs to be in 2025. I don't know if that helped.
It does, JJ. Thank you.
Thank you, Brandon.
Your next question comes from the line of John Chappell with Evercore. Please go ahead.
Thank you. Good afternoon. Ghislain, we've talked about the cost initiatives and the pricing strategy as part of the broader 2022 strategic plan. No comments on the reviews of some of the non-core businesses and maybe the trucking units specifically. How are those reviews gone, and are you still on plan for the impact that those are expected to have on hitting the targets for next year?
So, John, Helen Quirk is actually working those files very specifically. She will give you the call you need. Helen?
Great.
Yeah, thanks, John. On our non-rail assets review, we've commenced the sale process for the Great Lakes fleet of vessels, and we have a number of interested buyers on that. This is a profitable business, but we believe that we do not need to own the vessels to protect the rail revenues and maintain a stable supply chain for our customers. With regards to Transex, it is accretive to EPS, and we've almost doubled the intermodal business of Transex since the acquisition. The profitability of the core Transex business is in line with best in class for similar types of assets, and we're still working through the options to potentially reduce our ownership interest while maintaining and growing the rail revenues there. We'll keep investors posted on this, but our message remains that we are a growth company. You've heard it numerous times today, and we'll continue to find ways through acquisitions and partnerships that will drive more business to our network over time. Thanks for the question, John.
Thank you.
Thank you, John.
Your next question comes from the line of Amit Mehrotra with Deutsche Bank. Please go ahead.
Thanks. Hey, JJ. Best wishes. It's been a remarkable and successful career, so wish you the best whatever next you do. I wanted to follow up on Brandon's question, your commentary about the new CEO. There's obviously another world-class executive on the sideline, so to speak, that TCI is bringing forward. And I just want to make sure, we're not reading the search. These searches can be long. They can be very expensive. Have you guys already considered this other candidate that TCI is bringing forward, and you feel like that's not the right way of CN wants to go? What's the strategy around doing an expensive long search when you do have someone that's tried and tested, willing to take over the reins, so to speak?
Yeah. So thanks for the question. This is an important question, but the board will consider all candidates, inside the company, outside the company, male and female. And there is a search, meaning that we will be very thorough and be sure that the next person who replaces me is the person that can really carry the CN strategy on a go-forward basis. So, that takes a little time, and that takes a very specific process. We're committed to the process. The board has set up a CEO search committee, which is led by Shawneen Bruder. Shawneen is our chair of the governance committee. And with her, we have Robert Phillips, who is a retired CEO, chief executive officer or chairman of British BCR. And then you also have Kevin Lynch, and as well as Justin Howell, who joined the board from Cascade. So this group will be doing, reviewing what is the profile for the CEO of the future at CN. They will look for all candidates, known and unknown. The search will remain confidential. We won't talk about candidates before the committee has a recommendation to make to the board. And the whole board of CN eventually, as it did in the past, will weigh in the final decision. So we know there is some candidate out there, at least one, but I think the world is bigger than that. And before the board make a decision, we want to do it to be very, very thorough.
Okay, that makes sense. Thank you very much. Appreciate it.
Thank you.
Your next question comes from the line of Brian Ossenbeck with J.P. Morgan. Please go ahead.
Hey, good afternoon. Thanks for taking the question. I wanted to come back to technology and what sort of benefits you think you're going to get from that across the network, and maybe some of the injury ratios, the safety, the fuel efficiency, capacity. We've heard about some of these initiatives for a number of years now, so I don't know if we're on the tipping point of them actually being able to generate some benefits along those lines, maybe perhaps helping reduce the headcount. So just wanted to understand what type of benefits you're expecting in the plan for 2022, specifically as it relates to some of these technology initiatives.
Yeah. So Rob is probably the closest to that. Most of the technology that we're deploying right now is in the space of operation mechanical. Rob, you want to talk about technology in your space?
Yeah, absolutely. And thanks for the question. So Probably the best example we have right now is our autonomous track inspection cars. We now have 10 of those that are running from coast to coast to coast, covering our core main. And some subdivisions are covering 15 to 20 times the previous inspection. That's really given us real-time information as we see it today. And, that's allowing us to make better decisions. Really, when you look at our CapEx for next year, a big part of that's based on using the technology, especially when it comes down to how we replace ties and our undercutting. That's a big part of our basic maintenance. So we are seeing those results. When you talk about fuel efficiency, we continue to raise the bar. We are the industry leader. Just in the last 2 years, just from our initiatives alone, we saved $75 million just from those initiatives. That's excluding fuel price and consumption. So really, really good work. We're continuing to see it. Jiz, I don't know if you want to mention anything regarding the actual dollars for next year, but we are seeing the benefits.
No, I think in terms of dollars, as you remember, Brian, we're shooting for a range of $200 to $400 million. I think that we slowed down a little bit in 2020 because of COVID, as you can imagine. But if you account for 2022 and 2023, I think we will be in the high range of those benefits, and we're continuing to track those very, very closely. So quite bullish about technology.
Yeah, and maybe technology also has a big part of our future on the commercial side. I don't know if Helen or Keith wants to talk about some of the stuff that we do technology-wise that is really aimed to attract more business or make business more sticky on the CN.
I'll start, Helen, but we're actually deploying some technologies now at our intermodal terminals that are improving the efficiency of the terminal, the capacity of the terminal, and the safety of the terminal. And that's going very, very well. It's enabling us to do more business through the terminals. It's creating a better customer experience for our trucks. They come in and out of the terminal. But Helen, you've got a few. No? Okay. Brian, with that, well, thank you.
Thank you, Brian.
Okay, I appreciate that, and best of luck to you, JJ.
Thank you.
Your next question comes from the line of Benoit Poirier with Desjardins Securities. Please go ahead.
Salut, Benoit.
Yes. Good afternoon, everyone, and best wishes, JJ, on the next steps. With respect to the supply chain issues, could you maybe provide some color on the business segments that are impacted the most, and whether it should become a tailwind going into 2022 as this becomes better?
Maybe I can start, but definitely when you look at the port business, business is somewhat down because, things on the ocean are not working the way they should. So we're turning this into a positive the way Keith described earlier. So now that we have some capacity at Rupert that on paper we was not going to be available, he can do so now, take some spot business, shuttle service, pendulum service with only Rupert as the only port of call on the North American side. And on automotive, I think everybody knows the story. The whole automotive industry is struggling to get chips, which mean that you and I are probably going to be deferring our purchase of a new car to next year when we have more choice of brand and color, and that's going to be a story for 2022. I don't know if you want to add, James, to what's happening in the carloads.
I would say the weak outlier we have is Canadian grain. I think everybody knows that story. In the first 10 weeks of this current grain crop, we're down over 1.5 million tons. That's bad news. The good news is, we're in a very unique position in that we have some strong tailwinds with coal. We got the potential of 2 coal plants reopening on our network. We got the full year effect of the tech deal that's going to drive us through for at least the first half of 2022. All in, we expect that coal is going to make up almost half of that gap we have with the Canadian grain crop. And then, of course, the grain crop gets reset Q4 next year, and we got some very high hopes. So if you think about coming out of 2022, we've got some strong momentum with a recovery in grain through end of 2022 into 2023. And then we've got some significant carload growth projects related to new crush plants and new activity around renewable fuels. Carries us forward 2024 and beyond. That's when we start seeing the significant growth in carloads related to the hydrogen economy all around Alberta. And I got to tell you, like I said in my prepared remarks, this could be big. This could be of the scale of crude by rail, but this is going to be long-term ratable carloads that move by rail, not rail when it's convenient, but rail all the time. So it's very exciting prospects for the future. So thank you very much.
Carloads from Alberta to the West Coast via Rupert to Vancouver. There's also a positive story on iron ore export.
Yes.
CN is doing iron ore export from the Gulf, and then we have a trial over Rupert, and a cold story at CN is all export, either via the U.S. Gulf or via the Port of Prince Rupert. Thank you, Benoit.
Your next question comes from the line of Jordan Alliger with Goldman Sachs. Please go ahead.
Good afternoon, Jordan.
Afternoon. A lot of the focus always is on operating ratio, the 57% target next year, but sort of thinking beyond that, not operating ratio, but sort of given the customer-centric pivot that you had done, what's the update and thoughts around the longer-term revenue projection for you guys? Not necessarily next year, but sort of beyond that, as you maybe we're at the optimal OR, but how do you think about the revenue growth long-term?
Thank you for the question. It's also, I find it's a refreshing way to look at railroading. Operating ratio is a key KPI, but it's a byproduct of the business. So we're focusing on growth. So CN is looking to bring more volume on the railroad. It makes the railroad more profitable, more viable when you have more freight on it, as opposed to demarket freight. So we're a growth company. We want to railroad for customers, so we need to have a customer centricity mindset and culture at CN to do that. Intermodal is an area where you can attract freight from on the railroad. Port business is another area where we can compete with other railroad networks to bring business on the CN. And James mentioned on the carload side, for us to attract companies like G3, for example, who announced recently 2 more grain elevators, 100 loops of loop track, 150 cars being built on our railroad because they like the way we railroad for them as much as we railroad for shareholders. So all these things really that's the way of the future, is to use a network for what it really is meant to be, to move a lot of freight and to be an enabler of the economy and to attract people like G3 or Dow Chemical to make major investment on our line or within our line with Canadian Network switching as an example. So I think these are the things that really are what DSR is all about, is use the network because it's very fuel efficient, lower carbon emission, it's safer than stuff on the highway, and use it for all it has the potential to be, is to be a big enabler of the economy and participate in what's good here in North America. Thank you.
Your next question comes from the line of Scott Group with Wolfe Research. Your line is now open.
Hey, thanks. Afternoon, guys. JJ, you made some comments at the beginning of the call about July versus September operating ratio, and maybe if you can just get some color there. And then longer term, it sounds like maybe there's a little bit of a change from the September call as the business grows past 22, that there should be further margin improvement. Maybe just a little color there and how you're thinking about operating leverage longer term.
Okay, thank you, Scott. So as I say in my comment, and that's important to clarify that, lowering the operating ratio starts with 57 in 2022. And we're not saying 57 is the end of it, but we say 57 in 2022, and we're confident we're going to deliver against that, is one way to railroad with balance, is one way to make sure that we create something in it for all stakeholders, users and shareholders, long-term, short-term, and making sure we don't leave the economy behind if, for whatever reason, the demand for trade transportation, especially in Canada, is going to surge back at some point in the future. So it's not about how low we're capable to go and how fast we get to that. It's more about how low should we go and over what period of time. But starting with 57 in 2022, potentially some further improvement beyond that. Let us go back to the trade here back early in the new year. And volume obviously is an important point. As much as the Canadian grain crop right now is a huge disappointment because we are set up for it. We have the capacity to move it, but it's not at the rendezvous. We are planning for an average crop for for late next year, and therefore revenue ton-mile growth will be back at CN. This year, I think if grain was to be normal, we would have, James, how much GTM growth next year?
6%.
6%. So it's 6%, but by the time you put in grain, the fact the crop's not there. So definitely it's a growth story, and definitely 57 we believe is where we should go next year. Not as low as we're capable of going, but it's more about where we should go, and it starts with 57 in 2022, and after that we'll see more to come in the future earning call. Thank you, Scott.
Thank you.
You had a question about August and July. So maybe, I think on that point, Rob would be in better position to talk about sort of the movement in our OR, kind of a month to month, and what happened here in July at CN.
Yeah, Scott, even though we don't talk about OR in terms of months, if we look at June and where we were at headed into July, of course, we lost the bridge right at the beginning of July for 2 weeks, and then that was followed by a ministerial order. So there's no doubt that July's performance impacted the quarter. But if you look at June to July, there's nearly a 10-point swing in OR, and the same thing when you look at September to July. So hopefully that gives you a little bit of color what we were looking at there.
Yeah, July was quite challenging from solid June, and then we lost the main line and all that goes on with it. Thank you.
Your next question comes from the line of Tom Wadewitz with UBS. Please go ahead.
Hi, Tom.
Good afternoon. TJ, I had one that's kind of a minor follow-up on a prior question, and then another one, if you will. I guess on timing, is the timing of your retirement at the end of January intended to kind of coincide with when the board would be done with their decision? Is that why you set it accordingly, or it seems almost implicit in that? And then I guess the second question just would be your broader thoughts on supply chain and kind of, we hear so much about labor constraints, but there's not a ton of visibility to that easing up. So I don't know if you want to offer some broader thoughts about, rail capacity improvement and volume growth broadly in 22, whether that's pretty visible or, is labor a significant risk to kind of, how CN runs or North American railroads run? Thank you.
Thank you. So on the first one, I'm not going anywhere, right? So I've announced my retirement, but at the same time, my job, and as I said in my opening comment, the whole team here on the table, our job is to deliver a very solid result in the fourth quarter, to finish on a high and prove to our investors and our customers that our 2022 business plan is real, and to be really set up to enter 2022 on a very solid footing. And I want to be here to deliver those results back to you guys and girls sometime in January. In terms of the timing, the board is not on a specific timeline. That they will find and determine the best candidate when they're ready, and therefore my mandate to the board is to be. My heart is to CN. I've been here for 25 years. I want to do what's right for the company, and I will leave when the board needs me to leave. That is when the board has the proper successor to be ready to step in the job. So that's where the flexibility and the beauty of all this come together. But very committed to the fourth quarter, committed to setting the company strong for whoever's the next CEO to have a very solid 2022, and committed to be here till the time that the board has announced to the person that will succeed me, whether it's a candidate from inside or outside, from anywhere around the world in North America, female or male or female. So I'm here at the disposal of the board and our shareholders, and I've done this long enough. My heart is to make sure that we do the right thing for the next step of CN. And regarding the supply chain, I think maybe James and Keith may have a better view than me on that part of the question.
Yeah, I would say if you look out at 2022, every single segment across CN is going to be growing in 2022, with the exception of our grain business. And grain, as we talked about, is a big hit. I pivot back to say we're so lucky to have coal as a backfill for grain as we go into 2022. And then again, just looking forward about all the growth prospects that start kicking in the second half of 2022 into 2023, it's something really to be excited about, and it's going to really create some opportunities for us, as we move forward here.
And Rob, on labor, availability of labor to move the railroad. I know there's some question on some of the U.S. property around the United States, but what about CN?
Yeah, so we're in good shape from a labor standpoint. We do see the sporadic, as we have over the last year and a half with the pandemic. We do see the sporadic outages that impact our labor, but really it's short-lived, and we're in good position here to handle it from a labor standpoint.
Great. Thank you for the time. Thanks for the perspective.
Thank you, Tom.
Your next question comes from the line of Chris Wetherbee with Citi. Please go ahead.
Hi, Chris.
Hey, thanks, and good afternoon. And certainly best of luck, JJ, in the next endeavor for you. I wanted to maybe ask a little bit, go back to that comment about September being sort of 10 points better than July, and obviously that's a function of both probably July not being particularly good and September being certainly better and gaining some momentum. But when you think about that, coupled with what you've already announced around headcount reductions, $100 million of cost savings that you're capturing here in 2021, I guess I'm curious how you guys think you're sort of running or maybe will be exiting 2021 in terms of that run rate towards the 57. I guess it's always been our assumption that there are some benefits of removing, say, Great Lakes from the business in order to get to that 57, so mixing the OR down by the loss of some of those higher OR businesses. But I'm kind of curious what maybe the underlying business is running at today based on some of the progress you've been able to make so far.
Yeah, maybe just without getting into guidance by quarter, by month. Just remember, so we said we have a target of operating ratio 57 for 2022, and in any railroad, including Northern Railroad, there's some seasonality in your OR. So December, January, February, March are winter months, especially in Western Canada, where 50% of our business is. So the operating ratio for these 4 months is higher than the other 8 months. You got to take that into account. Number one. Number two, we have made progress during the course of the summer, as Rob mentioned, recovering from the fact that we had lost the main line to Vancouver for 2 weeks, and also the work we've done here on labor and on the September 17th. So we're making progress, and as I said, we're really committed to enter 2022 on good footing to deliver against our commitment. I don't know if you want to add some other things, Ghislain, without getting into too deep in the guidance.
Yeah, I can add, Chris, that based on what JJ is mentioning, we are very confident to deliver our earnings guidance of 10% EPS growth. So, we have essentially 10 months behind our belt, so we have 2 months left. So we're very confident of that, and the OR will come with that guidance on EPS. It will be the result of that EPS growth.
Yeah, and also the result of, as you know, you've been at this for a while. The last 2 weeks of December sometime are kind of a crapshoot, meaning we could have good weather, bad weather, or customers might decide that they shut down because they want to, save on labor costs and sell the product they have in their warehouse. It all depends how they view the economy. So the last few weeks of the quarter, in the fourth quarter, sometimes the men spike up, sometimes the men spike down. It all depends how everybody's reading the economy and what they want to do in terms of closing their year-end book with lot of product on hand or have nothing on hand. But we're working hard to do what we said we would do, and I think that hopefully you see that in our third quarter result, and you see that we've been able to bounce back since the challenge of the month of July, which was after a fairly solid month of June. Hopefully that helps.
The color. Yeah, appreciate it. Thank you.
Your next question comes from the line of Steve Hansen with Raymond James. Please go ahead.
Oh, yes. Good afternoon. Thanks for squeezing me in here. I'll just echo everyone else. JJ, congrats on a fantastic career. But as it relates to my question and the new focus in the 22 plan, I'm just curious whether the board is contemplating any changes to the compensation structure of management to align around this new plan as we're looking forward, I guess, beyond even 2022. Thanks.
Yeah, it's a good question, and it's a question that the board asks itself at all time. Every year there's a discussion around what kind of compensation system should we have and whether or not we make some change to the compensation system so that it stays current about who we are today and what we want to be tomorrow. And those discussions take place all the time, including in current time. So I would say it's just an ongoing discussion. Whether or not we have an activist or not, this is something that the boards always look at, and they always look at the discussion in terms of the long term and what is that they define from the CN long-term strategy, and it needs to be aligned with that. So, we have nothing to say about what it might be in the future. In any event, that's not for the management to do that. It's for the board, but it's an ongoing discussion. But it's an ongoing discussion at all time, not just in current time. Thank you.
Appreciate the color.
This concludes the question and answer session. I would like to turn the call over back to Mr. J.J. Ruest.
Well, thank you, Charlie, and thank you for joining us today. We're into exciting time at CN at all time. We worked very hard this summer on closing a transaction which was very strategic to us and very much in part of the long-term strategy of growing our network. We convinced a lot of supporters, convinced the board of KCS twice, could not get the regulators to be on side. So now we're very focused on our current network and the great network that we have and exploiting that the best that we can. And then to that effect, we also rolled out our 2022 business plan early back in September 17, and that's what we're very focusing on. As I said earlier, I'm not going anywhere. I'm here with the team to deliver a very solid fourth quarter result and make sure that we enter 2022 with the year set up that we could be successful next year in producing the result that we talked about. And I think today we've also clarified some of those things that maybe are more clear to you at this point. So between now and then, stay safe, and we'll see you in January. Thank you.
You're welcome. The conference call has now ended. Thank you for your participation. You may now disconnect your lines at this time.